Welcome to Crypto Jargon, the series where I am breaking down the most commonly used terminology in reference to cryptocurrencies, trading and blockchain technology. In today's episode, I will look into some of the most common chart patterns that we use in technical analysis. In the previous episode, I outlined what is support and resistance, also a breakout and a few of the indicators that help forecast them. And I also mentioned the wedge pattern, which is one of the patterns signaling a bullish or bearish potential. So in this episode, I will add some more patterns that we observe that can help us forecast possible uptrend or downtrend moves. On a very basic level, chart patterns are a way of viewing series of price actions. It can be over any time frame, monthly, weekly, daily or even shorter. The great thing about chart patterns is that they tend to repeat themselves over and over again. So by recognizing these patterns, traders gain a better picture about the markets and use them to identify trend reversals and continuations. First, I will start with the Pennant. This is a pattern created when there is a significant movement in the price, followed by a period of consolidation. This creates the pennant shape due to the converging lines. A breakout movement then occurs in the same direction as the big move. These are similar to flag patterns and tend to last between 1 and 3 weeks. There will be significant volume at the initial price movement, followed by a weaker volume in the pennant section, and growth in volume again at the breakout. Ascending triangle. This triangle usually appears during an upward trend and is regarded as a continuation pattern. Sometimes it can be created as a part of a reversal at the end of a downtrend, but most commonly it is continuation and at the same time it is signaling a bullish scenario. The opposite is a descending triangle, also a continuation pattern, but this triangle is a bearish signal and it's usually created as a continuation during a downward trend. Bullish symmetric triangle. The symmetrical triangle pattern is easy to spot thanks to the distinctive shape, which is developed by the two trend lines which converge. This pattern occurs by drawing trend lines which connect a series of peaks and lows. The trend lines create a barrier, and once the price breaks through these, a very sharp movement in price follows. The breakout signals the start of a bull run, which could be quite a jump with a lot of volume and significant price increase. The flag chart pattern forms through a rectangle. The rectangle develops from two trend lines which form the support and resistance until the price breaks out. The flag will have sloping trend lines and the slope should move in the opposite direction to the original price movement. Once the price breaks through either the support or the resistance lines, this creates the buy or sell signal. Triple bottom pattern. This forms over time as the prices move between support and resistance and test the support again and again, but each time the support holds strong, which can form three distinct and almost equal valleys on the chart's trend line. Once the third valley has formed, an upward trend will develop past the point of the peaks formed during the pattern's formation. When this happens, the market is likely to be bullish for a while, and the triple bottom pattern is considered a reversal pattern transitioning from a bear to a bull market. This happens in reverse too with the triple top pattern. It forms on a market chart when the resistance is tested multiple times, which forms the three distinct and almost equal peaks. If the third time this resistance does not get broken, then a downward trend will develop past the point of the previous dips, indicating a bearish or downward trend has begun. The triple top pattern is considered a reversal pattern, transitioning from a bull market to a bear market. This can happen also just after two tests of the resistance, which we call a double top. Most likely this would be observed over a larger period of time, such as the weekly time frame, and it's the same as the triple top but without the third peak. So two peaks of almost identical shape are formed, and after that the price goes in a downward trend for a while. This is because the sellers are putting a lot of pressure on the market at the price level where the peaks are formed, and the buyers are unable to push that price any higher. Either they're not ready to buy at such a price, or there are more sellers who sell at that price level, so there is more supply, which caters to the demand and surpasses it, which in return creates a devaluation of the price. This pattern is considered a reversal pattern, transitioning from a bull market to a bear market, and it can also happen in reverse, which is the double bottom. This pattern shows how we test the support level to see if we can push any lower, but as we get rejected twice, as soon as the second valley has formed, an upward trend will develop past the point of the tops formed during the pattern. It is a signal that the market is likely to be bullish. Thus, the double bottom pattern is also a reversal pattern, transitioning from a bear to a bull market. Next is the cup and handle pattern, which gets its name from the obvious shape resemblance on the chart. The cup is a curved U-shape, while the handle slopes slightly downwards. In general, the right-hand side of the diagram has low trading volume, and it can last from 7 weeks up to about 65 weeks, so this is a longer-term chart analysis, and it is not used much with the hourly or shorter candlesticks, but mainly with the daily and weekly candlesticks. It is a bullish indicator showing a trend reversal from a long-term bearish to a bullish market. And lastly, very similarly looking, is the rounding bottom pattern, but in this case there is no handle to the pattern, as the name. This pattern is sometimes also called a saucer bottom, and it also demonstrates a long-term reversal, showing that the asset is moving from a downward trend towards an upward trend. It can last from several months to years. So this concludes today's episode. Feel free to share it with anyone who might benefit from watching it. And if you are new to this channel, I will urge you to subscribe and hit the notification bell so that you don't miss the next episode. Also, links to the other episodes are in the description box, so make sure that you check them out. Thanks for watching, and I'll see you in the next one. Enjoying this content? Go check out Crypto Jargon, the ebook, out now on Kindle. It's an Amazon bestseller, and it's the most up-to-date crypto dictionary with more than 700 terms, acronyms, and trading slang related to cryptocurrencies and blockchain tech. Just go to ojjordan.com/cryptojargon and grab your digital copy today.